Good evening, everybody, and welcome to Overberg Asset Management's presentation on investment freedom during turbulence. This is a pre-recording of the actual presentation I will be giving at Ermel Golf Club on the 29th of March 2022. So we'll be looking at how to invest your money during times of turbulence. We're currently seeing or experiencing a lot of turbulence and uncertainty with the Russian-Ukraine war, and we will be looking at the war, but specifically how it fits into the macroeconomic backdrop that's currently at play. So the agenda for today is we're going to look at the current environment to see where we're at in terms of the macroeconomic variables that I've just mentioned of interest rates, inflation, and then see how, if you add an external factor such as war to it, what the outcome currently is. Then we're going to go into history. We're going to look into past experiences or past wars. We're going to see what the economy of during those times, what the economy was like, and what the external factor of war did to markets and investments. Then we're going to touch on what Overberg Asset Management expects for the rest of 2022 and 2023 and beyond. We're going to touch on our strategy, how we actually manage investment portfolios during these uncertain times. Then we're just going to look at, briefly touch on the portfolios and how they have performed for the year to date. And then we're going to conclude. And you are more than welcome to email me any questions should you want to do it. You can find my email at the end of this presentation. I think if you look at the current environment, it's good to split it into the COVID and post-COVID part. I think what happened during COVID painted the picture of what's happening now in the post-COVID world. So when the world went into lockdown and complete economic shutdown in 2020, global trade didn't happen, and subsequently you saw inflation drop to record low levels. Global inflation at the lowest point dropped to 2.6%. South African inflation was around 3 to 4%, and the US inflation at its lowest point was 0.33%. So those were record low inflation numbers. So because the economies went into shutdown, governments and central banks around the world tried to stimulate to keep the world and the economies from collapsing completely. So they did that with various measures. Both monetary and fiscal policy played a role this time. Monetary policy did their part by lowering interest rates to basically zero in the first world. They ran new quantitative easing programs where they supplied the market with big liquidity. There was big money printing also on the monetary policy side. And then fiscal policy, we saw various business rescue packages and direct checks to households and various other measures which governments used across the world to stimulate and pump up their economies. So heading towards the post-COVID world, when the world started opening up again, we saw supply chain shortages. Now that supply chain shortages combined with the record stimulus actually started to reverse that low inflation figure. So we started seeing inflation going in the opposite direction. It was going up. So central banks around the world originally said it's just a temporary measure. As soon as the supply chain issues resolve itself, inflation won't necessarily be a problem, but they definitely will increase interest rates to combat any potential threat of inflation, and they will start to reverse all the stimulus spending that they've done, to the tune of, currently it's being reversed at quantitative easing spending or stimulus to the tune of $100 billion a month. So it's quite big, a big reversal of what we see during COVID. However, it seems that inflation is becoming a little bit more sticky than central banks initially thought, and they might need to clamp down harder on inflation and increase interest rates more aggressively than they originally thought, and in a more quicker time. If you add the Russian-Ukraine war as an external variable to the inflation figure and to the macroeconomic outlook, it adds to the inflation figure. I mean, you're seeing oil running at $120 a barrel, so that just adds to the inflation problem. On this slide, I'll show you a graph of inflation and interest rates. This is the US inflation and the Fed funds rate from 1982 to the present day. What you'll pick up on this slide is there's an extremely strong correlation between interest rates and inflation. It's since the 80s, it's actually tracked downwards due to various factors. So the long-term trend for inflation and interest rates generally is lower. As I've said, it's due to various factors, and those factors are the technological improvements and globalization. So being able to trade with countries that produce products at a much cheaper cost than you might do generally is good for global prices. I mean, we're all aware of trade with China. So if you've ever been on an Alibaba website, you would know that you can buy a lot of things at very decent prices and ship it across the world. So this situation where inflation has been steadily coming down since the 80s have allowed central bankers across the world to actually be very accommodative and keep rates low and keep the world supplied with liquidity, which is good generally speaking for markets. But having a look recently, as I've said in the earlier slide, in the post-COVID period, we're seeing a big spike in inflation. Now, seems, as I said initially, it wasn't a real worry for central banks or the markets, but recently it seems that it's becoming a bit of a concern as inflation numbers are quite high. I think those those previous readings that we saw at 3 to 4% are now actually running at 6%, 6.5%. I think the latest reading from the States is 7.5% for an inflation figure. And you can see on this chart, inflation has gone up, but interest rates hasn't really gone up yet. So the next step would be for central bankers to actually start to increase interest rates to combat inflation. The question is just how aggressively are they going to do it? As I said originally, they didn't seem it as much of a big problem. However, they're becoming more hawkish recently, and it does sound that they are going to increase interest rates more aggressively than they originally thought. And again, adding the external factor of the Russian-Ukraine war to it, it just adds to the oil price going to $120, or oil going to $120 a barrel adds to the inflation problem. So in the next section, we're going to go into history and see, we're going to go look at a few wars and see how markets have reacted during those war times and see if there's any lessons we can learn from it. Look, it's always hard to pinpoint the exact start of any wars. Tensions typically boil for years before the first shot gets fired. But I believe there are valuable lessons we can learn by looking at past wars in history. The first war we're looking at is the Vietnam War. There's also a 20-year war, which was a proxy for the Cold War. So you had North Vietnam versus South Vietnam. The South Vietnam is backed by Western allies and their system of free markets, and North Vietnam backed by the communist East. But before we look at the war itself and exactly how markets reacted, I think it's very important to understand the macroeconomic environment at the time and how policy, specifically monetary policy, reacted to the macroeconomic conditions and how that actually set the table for what transpired in markets. So what I've got here is a graph of the S&P 500 from 1962 to 1970. So what you can see on this graph is this is the S&P 500. It went up. So The economic conditions at the time was very good. The economy was growing, interest rates were low, money was cheap, rates were running just at 3.25% in 1964. That's just before the US increased their involvement in the war. And because times were good and money was abundant and businesses were doing well, the markets went up. As I said, the US involvement increased in this war in 1965 at the Gulf of Tonkin incident. The markets dropped at literally 3% at that time, and then it just tickled on its way. So what we can see here is when the economy started overheating, we started seeing inflation, and when inflation started picking up, that's when monetary policy started to tighten. And when monetary policy started to tighten, money got more expensive, and what you saw subsequently is markets pulling back. So that first pullback there was about a 28% pullback in the S&P 500. So it's quite a substantial pullback. So that transpired, and the economy slowed down again, and inflation started dropping. And then the Fed were in a position to lower rates. They lowered rates to 3.5% in 67. And then the whole scenario started reversing again. So you started to see the economy doing well again. Businesses started to flourish. Money was cheap, and money flowed into the stock market, pushing valuations higher and higher and higher. But the war, as I said, had a minimal impact originally. However, the US did start running some fiscal deficits to fund the war. So the fiscal deficit spending from the US, along with the economy that's doing really well, added again to the inflation figure, and subsequently monetary policy reacted by increasing interest rates to 10.5% in 1969, and again it burst, or the bubble burst, and markets started to decline again. That was actually a recession. This first drop wasn't a recession. The economy was still doing very well. It's just a bit of a market pullback. But here we actually saw GDP growth declining. But it was a very brief recession. It didn't last very long. The second war we are going to look at is the Gulf War. Now, this transpired in 1990 to 1990, or in the early 90s, I should actually say. So this was when Iraq invaded Kuwait in August of 1990. So this to me is very similar to what we are seeing today with the Russian-Ukraine war. There's a lot of similarities, and I think we can learn a lot of lessons here. So what actually transpired during this war is Kuwait produced more oil than their OPEC quota allowed them to, which kept oil prices low. Now, Iraq felt this was a threat to their economy, and so they just decided to invade Kuwait. Now, where it gets similar is upon the invasion, oil prices started going up, and the invasion was met with international condemnation and a lot of economic sanctions. And later on, troops of the US and the UK and the West actually entered the war. But if you look at this graph, so I've highlighted, or I've marked where the invasion happened with that yellow dot. So what in August 1990? But again, as per the previous war, I just want to paint the macroeconomic environment at the time. So leading up to 1990, the economy of the US and the economy of the world were actually doing very, very nicely. Economic growth was strong, and interest rates generally were very, very low, which again leads to borrowing, and it leads to investing in businesses and speculation, and then generally the stock market actually went up. But what that did do, yes, is if you go back to that pre-graph I've showed you, on the first or the second slide, which with the long-term inflation, you would see inflation started to pick up. Now, to combat that inflation, again, monetary policy increased interest rates. So interest rates actually hit a high of 10.99% in 91. So interest rates almost doubled in a very short period of time. So that was the macroeconomic backdrop. Now, if you add the external factor of the war to it, and you add oil prices going up due to the invasion, you saw this market pullback. So yes, you can argue that market drop of 15% is due to the war, but I would argue that the macroeconomic conditions at the time lent itself to a market correction. The actual invasion of 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 Kuwait just was the straw that broke the camel's back. However, a 15% drop isn't really a big drop, and markets quickly recovered and made new highs very soon after. The last two wars that we're going to look at is the Afghanistan War and the Iraq War. I've actually put them both on one slide purely because they are part of the war on terror. We all remember the 9/11 incident where those planes crashed into the Twin Towers, the Pentagon, and that field in Pennsylvania. Um, and I've marked the on that graph, I've marked the air campaign in Afghanistan that started in October in 2001, as well as the invasion of Iraq in March 2003. But I think, again, as per the previous wars, I just want to paint the picture of what the macroeconomic conditions were like at the time and what monetary policy's response were to those economic conditions. So in the lead up to the 2000s, we saw a big, well, the economies generally were doing extremely well across the world, and interest rates were low, and there was a lot of borrowing and a lot of speculation. So, and there was a new kid on the block called the internet, and there was a lot of money and speculative money going into the internet sector. Now, there was a lot of companies listed that investors could invest in. But the problem with cheap money and speculation is it drives up valuation. So you can see from 1997 to I think it's to the 2000s, if I look correctly, the S&P 500 more than, or almost doubled. So because it was in speculative territory, valuations were very much sky high, and the stock market was just overvalued. But because it was going so well and the economy was doing so well, people got rich from investing in internet stocks, inflation started picking up. And as soon as inflation started picking up, monetary policy reacted by increasing interest rates. So where rates were as low as 2.85% in 94, they were up running at 6.86% in the year 2000. And that was the thing that made the bubble burst, and the whole internet speculation story collapsed. So all the gains that were made from 97 to 2000 on the S&P 500 were lost very quickly in the year or two thereafter. Yes, there were the Twin Towers that collapsed, and the retaliation by the US and the invasion in Iraq, which you can see on those two points over there. Sorry, just get my cursor, my highlighter over there. But those wars were proved to be external factors. The biggest driver of this market correction or market collapse, it's not a correction, it's actually just the markets were completely overvalued, were the speculation in internet stocks. So even at the low point when the US entered Iraq, it didn't really affect the S&P 500 at all. During that time, there was a big recession. So what happened was monetary policy reacted by lowering interest rates. And when rates started to lower, we saw that markets started to recover again and go up and make new record highs just a couple of years thereafter. So what are the lessons we can learn from looking into history? Look, wars alone aren't always responsible for market drops. I think the macroeconomic environment at that time mostly determines which way markets go. If you add the external factor of a war on top of that, yes, it might send the market in certain directions. But if the macroeconomic conditions at the time is not favorable and rates go up and money becomes more expensive and liquidity dries up, generally that's negative for the markets, and the reverse is obviously true. So I think it's Warren Buffett who said interest rates are to the value of assets what gravity is to matter. And I think it's going to be the exact same thing this time around with this war with Russia, between Russia and Ukraine. We've seen an initial market drop, but it's also it coincides with the story of inflation, high interest rates, and central bankers responding to that. So, what's our expectations for the rest of 2022 going into 2023 and beyond? Look, it's quite clear we think inflation will continue to rise initially, but it should get back to target levels in the latter part of this year. Look, we expect quantitative easing, tightening to continue. In other words, all that stimulus that I've spoken about on the first few slides is being reversed. The Fed is reducing their balance sheet on a monthly basis by about $100 billion, so it's quite substantial. And yes, central banks will continue to raise rates. So to combat inflation, they want to be proactive rather than reactive, and make sure the inflation problem doesn't get out of hand. This will lead to global growth slowing down a bit. We don't suspect, or we don't think it will go into recession, as there's still a heck of a lot of pent up demand in the system. And once those supply chain issues get resolved, you can expect good growth numbers. If we look at company financials coming out, it's quite good, and growth is quite strong at a company level. But we do suspect growth to slow from the 6% in 2021 to about 3%, 3.2% in 2022. That's 3.2% have been lowered after the invasion of Ukraine and the increase in oil price. However, we do feel that the oil price it's actually been oversold. Oil has been oversold. The 120 level is very expensive, and once the supply chain issues resolve and there's more stability on the war front, then oil will more than likely start to come back down. As I said earlier, we don't think a recession globally will happen, but there might be a short European recession. I know there was big sanctions against Russia at various levels, but Europe's still very, very much reliant on Russia for energy. So if they are actually going to if the sanctions are going to creep into energy exports from Russia or imports from Russia, then there's a very good chance that Europe might dip into a short recession. So we can expect volatility for quarter one, which is almost done, and quarter two still, but I think things will stabilize in quarter three going into 2024. And as I've said, there's still a lot of pent-up demand following the COVID lockdowns. The economic figures coming out of companies and countries are actually very, very positive, extremely positive. So the initial inflation shock was a supply chain issue shock, and there's still a lot of overhang from that. So once that gets resolved, we expect to see inflation come down along with oil prices coming down. So what's our strategy? How do we manage our clients' portfolios during these uncertain times and these turbulent times? So the global portfolios, we just try and keep our equity exposure at acceptable levels. For the growth portfolio, we've got about 60% equity. The balanced portfolio is running at less than 50% equity. So we try and make sure our asset allocation is correct and on point. We still think that asset allocation remains the best risk mitigating factor. We've recently reduced European exposure. As I've mentioned in the previous slide, there might be a chance of the Eurozone going into a short recession. So we've just trimmed back our exposure to European equities at the moment, and we'll just keep that in cash for the time being, but we will redeploy it at a later stage when there's more green lights coming from the war front. We're going to keep our exposure to financials. So in a rising interest rate environment, financial stocks tend to outperform. I've written an article in Biz News on the 30th of November last year, which made the point that to not overlook financial companies, specifically banks, which would do well given the environment we're in with inflation and rates, specifically rates going up. But I'll post a link to that article in the description. Then on the local front, we maintain adequate resource exposure. I think with any uncertainty or with any type of volatility, as we've seen now, resource prices tend to do very well, and that's held up this time again. The rand's really strong now because we are still seen as a commodity country and a commodity currency. So we'll keep our adequate resource exposure in the local portfolios through Anglos and Amplats. Also, the same story applies in South Africa. Interest rates are going up, so we're going to keep exposure to financial companies, similar to that in the global companies. And then we'll just continue to look for value. I think we've held the belief that South African market's fairly cheap for a while now, and it's proven it's worth during this time. I think when the global markets have dropped, South African markets have kept quite stable. Then just on the portfolios itself, the asset allocation, this growth portfolio, the most aggressive portfolio, we've got about 78 or 79% equities, which we hold because we still think that South African equities offer value, and the balanced portfolio is about 60 to 63% equities. Interesting on the balanced portfolio, we are heavily invested into preference shares, but they are being bought back currently by a lot of companies. So in time we'll replace those preference shares with bonds. So this slide just touches on what we've done year to date on the various portfolios. So on the global growth portfolio, which is measured in pound terms, it's down 6.2% to date. So it's actually a very good time to add to a portfolio like that. As I mentioned earlier, we sold out of Europe, but as European shares drop and go low in value, it just the entry level back into those assets become very more attractive as time goes on. The balanced portfolio is down 4.9%. A similar story there. We lessen our European exposure, but we're just waiting on the correct time to get in. Defensive portfolio is down 3.1%, and the ETF portfolio that I manage myself is up 0.1%. On the local side, the growth portfolio, which as I've mentioned earlier, with the 78-79% equities, that's done about 0.4%. The balanced portfolio, which have got the substantial exposure to preference shares, have done 1.2%, and the income portfolio which have also got a significant exposure to preference shares, have got about a did 0.76% for the year to date, which we are fairly happy with. As I've said, those preference shares will eventually, when they are when they are bought back by the companies that have issued them, we'll just reinvest the proceeds into bonds. But again, even with the South African investments, there's still a lot of value to unlock there, and some of the holdings in those South African portfolios have European exposure, and they've also dropped quite a bit, and they offer extremely good entry levels from these. Or it's an extremely good entry point from these levels. If you remember those earlier graphs, I think the biggest drop we've seen with these turbulent were 28%, and then quickly the markets just recovered. And you can see from our portfolio performance, we've not nearly dropped as much. We've due to our asset allocations. So we are fairly happy with this performance, and we expect the portfolios to end the year higher than they've actually started the year. But the heavy lifting will be done in the latter part of 2022, in quarter 3 and quarter 4. Then just to in conclusion and to sum it up, I think inflation and interest rates and liquidity remain the drivers of market movement. So you can add an external factor such as a war, but those macroeconomic variables tend to dictate which way markets go. Inflation and interest rates are on a downward trajectory since the 80s, and we expect that to continue. Yes, we've got this spike now, but once that's out of the system, given all the technological advances and global trade, if it returns or when it returns, it should be it should place downward pressure on inflation. Central banks will remain hawkish. In other words, they'll look to increase rates more aggressively than they originally said they were going to do to fight inflation. So this will lead to a very volatile quarter 1, which we've seen, and expect a volatile quarter 2. But as I've said earlier, I think the numbers coming out of various economies and companies are still very strong, and there's big pent up demand following the COVID lockdown. So once we get back up to trading again, and the supply chain issues resolve itself, then we can expect decent growth from quarter 3 and beyond.